So the dollar, Trump last time around, same thing. The markets priced in tariffs. The dollar screamed higher. It created this weak patch of growth. Trump came out and said the dollar's too high. Guess what? Scott Bessent, who's a macro hedge fund manager, I've known him for 20 years, 25 years. He understands the game. Trump said the same thing. Everyone said the same thing. The dollar's too strong. And hey presto, the dollar has utterly collapsed. So it's a very powerful setup. A weak dollar is incredibly good for world growth. It allows China, everybody else to start exporting. The whole world economy starts picking up. The last time this happened, the Trump cycle, well, that was the initial correction that we got. We had this whole period of correction, much like we've had now. It stopped in about March. Well, we got to about April. And then we did this. And from that correction low, it did a 23x.
Over the past month, Bitcoin and the broader crypto market have experienced intense volatility, driven by shifting economic signals and powerful institutional forces. As investors adjust expectations around potential U.S. Federal Reserve rate cuts, prices have swung between sharp rallies and sudden corrections. Spot Bitcoin ETFs continue to be a major driver of momentum, with inflows pushing prices higher and outflows triggering quick pullback. Additional pressure comes from evolving regulatory developments in the U.S. and Europe, alongside rising geopolitical tensions. These forces are reshaping Bitcoin's identity, blurring the line between a high-risk speculative asset and a potential safe haven in times of uncertainty. With Bitcoin and top altcoins trading sideways for weeks, investors are asking, has the bull market peaked, or is this just a pause before another explosive move? While some fear another long crypto winter, Real Vision CEO and macro expert Raoul sees it differently. In a recent keynote at SUI 2025 Basecamp, he outlined compelling evidence, highlighting historical patterns and strong correlations between Fed liquidity cycles, interest rates, and crypto performance. According to Pal, all signs point towards significant upside for Bitcoin and the wider crypto market in 2025 and beyond.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
Firstly, I use a framework that I call the Everything Code. It's something that I've spent 35 years building in macro, where I started to realize that the dominant factor in all of macro is actually liquidity and the debasement of currencies, and it explains most price movements in all of the assets that we care about. And I realized it's all to do with debt, and it came from why we're seeing 4-year cycles in crypto and the economy and all of these things is actually driven by the debt refi cycle. The world just reached too much debt back in 2008, and what we've been doing since then is servicing the debt. We've also got some other key factors. This chart is a chart that I produced a few years ago. It's still the single most important chart in macro and explains everything that is going on in our world today. And this is the fact that demographics is everything, and the demographics of the aging populations across the Western world, these are the US numbers using the labor force participation rate, explain the build-up in debt. Why that is as populations get older, economies slow down. To service the existing debt, it requires more debt. To create GDP growth, you need more debt. See, GDP growth is driven by population growth, productivity growth, and debt growth. And debt growth has been the driver both in the US, in China, in Europe, in the UK, all across the world. It's all driven by the same dynamic, and that's this aging population thing. It slows down GDP growth and creates unstable economies. And that chart just shows the stunning correlation between debt to GDP and population itself. What's interesting is then when you go one stage further and say, okay, we're seeing this debt, how are we dealing with this debt? And it's actually just driven by liquidity. So here I'm using Fed net liquidity. Fed net liquidity is the balance sheet of the Federal Reserve, the Treasury General Account, which is the Treasury themselves, not the Fed, and then the reverse repo facility. These are the levers that they've been using. It started just using the balance sheet, 2009, all the way through to about 2014, it was just the use of the balance sheet. Then they started sneaking in new ways of debasing currency, and that was by adding in these other levers, getting banks to put reserves here or take reserves out there, or injecting money into the economy via the checking account, the Treasury General account. That's actually shifted to total liquidity now because everyone figures out the game, which is the debasement of currency. Debase the currency, try and grow GDP growth and lower debt to GDP, or just manage it. Now they're using total liquidity, which includes measures like M2, which is the banking system as well. So when you add those things up, this has, and I'll show you these charts later, the most stunning correlation of all time to all assets. So 90% of Bitcoin's price movements are driven by total liquidity, and 97% of the NASDAQ. So here's the real issue here. Why are the rich getting richer, the poor getting poorer? Well, scarce assets keep going up in price. Real estate, equities, art, gold, all of these things. Young people can't afford it. Poor people can't afford it because they've got variable income, which is earnings, and it buys them less of these every year. What's actually happening, what that mechanism is a tax on everybody of 8% a year. A global taxation of 8% a year that you don't understand. You just don't get richer by 8% a year. Add in another 3% global inflation, you're at 11% debasement of currency. That's your hurdle rate to stay as wealthy as you are today. That's a staggeringly difficult thing, considering most asset classes don't produce those kinds of returns, which is why so many young people have come to crypto, because crypto completely upends this system. They can't buy houses. They can't buy all of the other things that older people were able to afford. So they forced into more speculative, higher risk assets that have much higher returns. It's the only way out of the trap. And the trap is driven by this debasement. So if you want to see how close the correlation is, and I'll show the full correlation chart later, it basically drives Bitcoin. And what we see is there's periods where it decouples, and these are the banana zones. It decouples when what we get is the retail frenzy, and the frenzy into the market, cools off, comes back to trend rate of this debasement of 8% or so. But over time, it produces astonishing returns. And that's why Bitcoin looks like this on the log regression channel. It's also still remarkably cheap. Where it ends up at the end of the banana zone is usually the 1 or 2 standard deviation level. We're a long way from that, and that would give us much higher prices. You can't see it on this. But if it were to get to 2 standard deviations, that would put Bitcoin at $850,000. I don't think it's going to go there. But what we're saying is there's plenty of upside to come. I know people get frustrated in sideways markets. It's just the nature of the beast. It does nothing, corrects for a while, and then explodes out of the traps. And we're kind of in that phase now that I'll talk to you about.
Raoul Pal has laid out more than just a Bitcoin forecast. He's revealed a clear blueprint for understanding the entire financial system we live in today. At the core is liquidity, the force that drives markets higher and sustains them during downturns. Pal argues this cycle of liquidity isn't random. It's tied to global debt, aging populations, and a financial system that continually debases currency just to stay afloat. In this environment, scarce assets like Bitcoin are emerging as the only real defense, especially for younger generations who are priced out of housing and traditional investments. Pal warns of an invisible 8–11% annual decline in purchasing power, a hidden tax most people don't even realize they're paying. For him, this isn't the end of the crypto cycle, it's the setup for the next major wave. Bitcoin historically moves in phases, long, quiet consolidations followed by explosive rallies. According to Pal, we're still far from the euphoric peaks of what he calls the banana zones, where prices go parabolic. So while the market may seem slow or uncertain right now, powerful forces, including rising liquidity, demographic shifts, and ongoing currency debasement, are quietly building pressure. And when that pressure finally releases, Pal believes Bitcoin could break out dramatically. Maybe not all the way to $850,000 as some models suggest, but high enough to make today's sideways action look like the calm before the storm.
Crypto is a super massive black hole that simply outperforms and sucks every other asset dry. This is the big one, the biggest one we've ever been given, the greatest macro opportunity of all time. We've got the central banks debasing currency, which is giving us a gigantic tailwind. They don't want the system to break, so every time something happens, they inject more liquidity. So they're giving you free money. And to take that money, you need the volatility. So what causes the volatility? Well, it's actually driven by liquidity again. Once you come to narrower time horizons, liquidity changes things. So we've just gone through a 3-month period of the market feeling shit and everyone's saying it's all over, we're never going to have alt season, everything's terrible, we're all going to die. What was actually happening was the fact that in Q4 2024, financial conditions tightened. And we measure financial conditions by the dollar, rates, interest rates, and oil. All of those went up in Q4, and there's a 3-month lag, and it drives it. So here's a simple way. We're now seeing people saying the economy's slow, shipping slow, all of the tariff stuff. The markets priced in this tariff stuff last year once they saw the probabilities of a Trump re-election. So what we've got here is the economic surprises index of the US versus other countries in the world, i.e., when it's going down, the US is underperforming in economic surprises term. When it goes up, it outperforms. It's basically just following the dollar and rates. And what it's saying is, whatever noise we're seeing now in the economic data, which is some of the tariffs-related stuff as people have built inventories very quickly, liquidity is going to completely erase that very quickly. We saw it exactly in 2017 when Trump imposed similar tariffs, similar backdrop. The dollar and rates fell. And what we saw back then was the same collapse in the economic surprises index. We had talks about recession all over again back then. Trump's going to create a recession. Then what happened was the liquidity conditions drove all economic data higher. And when we look at that economic data, Bitcoin's already priced it in. It's already priced in, weaker than the economic data itself. So what are we fearing right now? What are people worried about? People are worried about what they're doing is creating narratives for today to explain liquidity conditions from 3 months ago. That's the ridiculousness of what goes on Twitter all day, is a lack of understanding of what actually drives these markets. What are the dominant factors? The dominant factor is financial conditions, which lead liquidity, which lead markets. And even in markets, it's gold actually follows financial conditions the closest. Then with a lag, it becomes crypto and tech. Then with a lag, becomes the S&P 500, cyclicals, commodities, all of those things. So people are talking about recession now. We've had this negative GDP print. A lot of this is technically driven by the imports that are happening to load up on inventories as tariffs come, so people don't have the price shock. Okay, fine. So most of this is going to get unwound. Why? Because global growth is about to pick up super fast. So the Philly Fed, this whole presentation was put together a week and a half ago to send here, so it's all out of date. So the Philly Fed latest numbers came in exactly as predicted by us, by this chart. It's actually quite useful because I just went through this deck this morning and all of this was from 2 weeks ago and it's all proven to work. So Philly Fed comes down now. So what we should see is now an increase in economic activity going forwards. So i.e. the back end of the year is going to look very different than the first quarter did. I use a lot of technical analysis. I even do it on economic data, which is abhorrent to most people, but it's worked for me for 35 years. And I use, this is a system called DMARC indicators. And basically it's telling you that we should see the economic surprises starting to rise. Bitcoin is led by financial conditions here by 3 months. The year-on-year rate of change of Bitcoin, we should start to see very dramatic movements in the price of Bitcoin going forwards. And I'll show you a bit more about this in a sec.
When analyzing today's macroeconomic landscape, it's evident that liquidity remains a dominant force shaping financial markets, especially in the crypto space. As Raoul emphasizes, factors like the strength of the US dollar and central bank monetary policy have a direct influence on asset prices, including Bitcoin. The relationship between liquidity and market performance isn't just theory, it's a consistent pattern we've seen across multiple market cycles. When liquidity tightens due to rising interest rates or a stronger dollar, growth slows and consolidation follows. But when financial conditions loosen, typically in response to economic strain, asset prices tend to rebound. Global debt plays a critical role in this dynamic. As governments and institutions manage growing debt burdens, central banks inject liquidity to maintain economic stability. These actions don't just support traditional markets like equities and real estate, they also create tailwinds for risk-on assets like cryptocurrencies. Bitcoin, in particular, has shown a strong correlation with liquidity trends. While today's environment may differ in some ways from past cycles, the underlying drivers, weakening dollar and expanding global liquidity, suggest continued upward pressure on Bitcoin and other digital assets. For investors, understanding these macroeconomic trends is crucial. Rather than reacting to short-term market noise, focusing on liquidity patterns offers a clearer picture of where the market may head next. As we move further into this cycle, guided by central bank strategy and global liquidity flows, the stage may be set for a new phase of growth. Do you believe liquidity remains the main catalyst for the crypto market, or do other factors play a bigger role? Share your perspective in the comments below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.